Understanding the failures and successes of other startups is invaluable for any founder or entrepreneur. It helps you navigate the complexities of managing your own business.
Welcome to our channel, Startup Business Management, your trusted resource for practical management know-how. Subscribe and follow us.
Hi, this is Surya Nanduri. Welcome back to Startup Business Management. In the first session, we introduced the concepts of startups and learned what is construed as a startup and what is not construed as a startup. In the second session, we explored some of the top startup friendly ecosystems and discussed how to decide where to operate from. If you missed any of the above sessions, check out the links provided in the description section in this video. Today, we will dive deep into key success factors of a startup. What determines the success of a startup? That's a $1 million question. The truth is, there isn't a single factor that guarantees a startup's success. A multitude of elements must align perfectly. Tens of things have to be in right place and in right time for a startup to survive and succeed. On the other side, just one factor can lead to the end of a startup. In the startup world, it is difficult to predict who will succeed, but easy to identify those who are bound to fail. Startup World reminds me of the title of a very popular Bollywood movie from the 90s, Jo Jeeta Wohe Sikandar. The one who wins is the king. We often hear only about these kings, while countless others fade into obscurity. For every success story, there are hundreds, if not thousands, of failures. Let me pause for a minute and clarify what we mean by success. Many mistakenly equate success with raising millions of dollars or acquiring the first customer. But that's a narrow view. For us to evaluate a startup's success, the startup needs to survive at least for one business cycle. One business cycle is typically about 5 to 7 years, having these four phases. One is expansion, the second is the peak, third is contraction or the decline, and fourth is a trough. So, only if a startup survives for about a business cycle, we should start evaluating whether the startup is a success or not. The business failure rate is alarmingly high. Over 21% of new businesses fail by the end of the first year. Nearly 60% don't survive beyond 7 years, and this number climbs to 80% in 20 years. Conversely, only 40% of businesses make it past 7 years, and this percentage drops to 20% after 20 years. Before we dive deeper into knowing the success factors, let's look at the failures. Venture funding, though witnessed a small rise in the first quarter of 2024, it is still far below the peak level, which is around 68% of the 2021 level. The deal count itself is on the decline, hitting the lowest of the past 8 quarters. It's shocking to see some of the high profile startups that went down in 2023. In CB Insight's list of top 10 most well funded startups that shut the doors since October 2023, the top two, Olive and Convoy, are notable. Olive offered healthcare AI solutions, while Convoy, once considered as the Uber for trucking, was a Uber like platform connecting the truck drivers with shippers who needed their freight to move. These companies raised over $800 million each at last peak valuations in the range of $3 to $4 billion. Olive's failure is attributed to lack of focus. The startup boasted of pivoting business around 27 times, but many feel that the startup did not have any focus. On the back of VC funding at high valuations, Olive not only acquired new businesses but also digressed into multiple healthcare businesses, which required specialization, from surgery analytics to claim processing. Olive even started a venture capital of its own. Convoy was riding very high on the trucking business boom during the COVID days, but couldn't sustain the freight recession that followed it. The founders did not have any experience in trucking business. Perhaps trying to replicate business models in a different sector is not easy as it seemed. In India, we have a live example in the name of Byju's. This edtech company touched a peak valuation of 22 billion and earned the status of most valued Indian startup in the history. However, lack of focus, pursuing growth aggressively by overborrowing, led to the downfall of this high profile company. All these failures are great examples, and the reasons for their failures perfectly find place in the top 12 reasons why startups failed, as per CB Insights report. 1. Ran out of cash, failed to raise new capital, no market need. That means there was no market need for the products being built by the startups. 3. They got outcompeted. 4 is a flawed business model. 5 is regulatory challenges, which we typically see in the case of cryptos and similar businesses. 6 is pricing and cost issues. 7, not the right team. 8, product mistimed. Either the product was too early or too late in the market. 9 is related to quality of product, which is the product itself being very poor. 10, disharmony among team and investors. 11, pivot having gone bad. And 12, burnt out or lacked passion. That means the founders themselves no longer had the passion in their startup. The survey and research conducted by Thomas Eisenmann of Harvard Business School on 470 startups that raised anywhere between half a million to 3 million in USA shows very interesting results. Though the study itself is about 4 year old, there is no reason to believe that the factors would have changed significantly. The study used the value of the seed round proceeds versus the subsequent value of the shares issued in the seed round. In other words, it is the multiple that the seed investors got or they were expecting to get in the subsequent round of funding. Startups were categorized based on the answer for the following question: how did the equity valuation change after the seed round? Did the value of the equity increase or remained more or less the same? Or three, it decreased. At the extreme, going to zero. That means the seed investors will not get their money back. Here are the findings. 1. Performance was better for startups whose teams followed lean startup management practices. These teams conducted more upfront customer research and ran MVP, that is, minimum viable product tests. 2. Performance was stronger when founders had greater confidence in their estimates of total addressable market size, unit economics, and the ratio of customer lifetime value to customer acquisition cost. 3. Following a structured, disciplined approach to human resources management, striking a right balance between recruiting for skills versus attitude, and having clarity on top management members' responsibilities were among the predictors for better performance. The following factors, surprisingly, and in contrary to popular notions, were not found to be any major determinants of performance. One is startups' reliance on strategic partnerships, whether the startup relied on partnerships to deliver the products and solutions, it did not matter. The type and the status of the seed investor, that is, whether the seed investment was from an angel, a VC, or an elite VC, this also did not matter. Now, coming to the several attributes of founders and CEOs, and I'm sure this is of interest to you, many of you. Holding an MBA or any degree from one of the world's top 50 universities. Second is whether the CEO or the founder had prior experience in functional roles, engineering, marketing, human resources. Third is prior relationships between co founders. And fourth, personal motivations for becoming an entrepreneur. It's very surprising none of these actually contributed to the performance of a startup, at least as far as the results of the survey are concerned. It doesn't matter whether you have an MBA, or it did not matter whether the founder or the CEO had any MBA degree from the top 50 universities, and whether the CEO or the founder had prior experience in functional roles, and the prior relationship between the co-founders, that also did not contribute to the performance. So it doesn't really matter where you found your co-founder, whether your co-founder was your childhood buddy or you met him in a coffee shop. It looks like it didn't matter. Personal motivation for becoming an entrepreneur, no matter what the motivation was behind starting the startup or behind starting your venture, if you look at the survey results, it doesn't really matter. The weak predictive power of founders' attributes in the study's regression analysis questions the conventional wisdom of many venture capitalists. Many venture capitalists hold the opinion that the ability of the jockey, that is the founder, is more important than the horse, that is the attractiveness of the startup's business opportunity. So here is a summary. What are the determinants of success? Rather, what you need at minimum to succeed in a startup. One, lean startup practices. Startups that employed lean startup management practices, particularly an optimal rate of pivoting, had stronger seed equity valuation growth. Two, balanced hiring. Ventures that balanced hiring for skills versus attitude and made early efforts to professionalize human resources management saw better outcomes. 3. Customer value proposition. A strong customer value proposition was crucial for early stage startup performance. 4. Product management. Effective product management practices were linked to better performance. 5. Team management. Startups that focused on team management and had founders' attributes such as leadership and adaptability performed better. Finally, nothing guarantees success in a startup. It's the determination and relentless persistence that leads to success.